All right, Sanjay Dutt of Quantum Security Johnson. Sanjay, fantastic to have you back. I'm interacting with you really after a while on air. So hope's all well, and you, your family, your loved ones, everything is safe.
All good. Thank you, Nikhil. Good to be on the show.
So Sanjay, I can divide the world into two. There are optimists who believe that whatever could go wrong has gone wrong. Things from here will only improve and they will only get better. That's one part of the market. Second are the pessimists who believe that it is only liquidity, it is only central bank policy action which is fueling asset price higher, and buyers should be beware. Which part of the camp are you in?
I think there's a gray area in between also, Nikunj. So I'm always slipping out and taking the easier way out and not willing to stake my neck out at this point of time. I think there is opportunity in the market, but at the same time, there is a lot of worry because across the world, you are seeing some of the lowest quality names, even in the US and even more so in the emerging markets, are now starting to rally and make use of liquidity. You know, the likes of penny stocks here, which have started hitting circuit every day. Liquidity is, something which you can't really control. It just flows. And the biggest problem is that people get sucked in. Now, trying to be a little more specific to your question, I think I'm optimistic, but I'm not optimistic on the market as a whole. I think now on, it's a market of individual stocks and it's a focus on bottom up. You need to figure out that worst probably is over. You won't go back to the 7,500, 8,000 levels of the Nifty or whatever. So therefore, you need to now identify stocks, get your levels correct, look at sectors which will rebound the fastest, which will be least impacted because of COVID, and at the same time, which will take the maximum advantage of liquidity and low cost of funds. So the theme being the companies that will survive, number one, this FY21 onslaught, the COVID, etc., who will be able to stay afloat. Those are the companies which will actually participate in the recovery, whether it's V-shaped, U-shaped, none of us have a clue at this point of time. But as investors, that's someone like me who stays put for 2, 3, 5 years, you need to get your companies correct and understand that these companies will survive the carnage. So therefore, I'm an optimist. I'm looking for opportunities, but opportunities at the right price. I'm not in the camp where I think fear of missing out, the FOMO, thing works, because you always get your prices. You just need to be patient and keep adding, keep your powder dry.
Investing is about allocating future capital to benefit from trends which would emerge. If the future is so uncertain, how does one position capital right now?
See, future definitely is uncertain, but at the same time, it doesn't mean that business activity, commercial activity, or company will shut down. We will still need equipment. We will still need capital goods. Investment cycle will come back. Probably it'll come back a year or two later. We've got this big theme working around the world where people are wanting to now not concentrate on China and not concentrate on a particular physical location, geographic location. So definitely India will benefit from that. And then within India itself, the government's clear that they want to increase manufacturing, increase focus on industries which can give more jobs, localize as much as possible. Now, these kind of themes are not going to get impacted when the future is uncertain. Yes, I'll have to live with 2, 3, 4 quarters, which very clearly some of the more mature companies have come out and said that whatever one might say about green shoots, it's a little too early to say anything. So it basically implies that FY21 is washed out unless we have some more negative news on the COVID front or something that may get extended. But I think on balance, the companies which will survive, the companies which are positioned to ride the domestic wave, particularly domestic consumption and domestic inputs wave, I think that's where we need to focus.
Sure. Sanjay, coming to, coming to a particular news focus this week, IT earnings kicking off with TCS. Just weighing up what we already know, not expecting necessarily an extreme impact, contrary to what we saw, during the GFC. But nonetheless, there's likely to be, some, of course, tapering when it comes to those numbers. They have said that they haven't seen any dramatic repricing of contracts, so on and so forth, so should be relatively insulated. But just in terms of setting the bar as we head into earnings seasons for Q1, which is where a large part of the impact during COVID would have been.
I don't think TCS or technology companies, particularly larger technologies company, would come out unscathed. They would have to deal with margin pressure. They would have to deal with, cost cutting that we are seeing across the world. There would be uncertainty on that front, but hopefully the uncertainty will last the short term. So I don't think this quarter results of TCS would be any indicator, but what's important is to get an honest commentary of the management as to where do they see their customers, their, the trends ahead in the technology business, and particularly in their space of business. But my own opinion is I don't think technology is a place to be overweight for the next year or two, because it's going to go through some challenging times, both in terms of margin pressures as well as in terms of growth ahead.
Okay, so that's on IT. When we're talking about growth, and I'm just specifically slicing it into segments here, I heard your overall view just a few moments ago. We've been talking so much about the rural recovery, how sales, particularly on the back of demand in those segments, have been picking up across the board, whether it be for segments like tractors or two-wheelers in the auto space, or of course FMCG and staples. Companies like a Parley saying they see no signs of slowing down, but others in the same space talking about how there is likely to be a speed bump going ahead. Question marks about whether this is sustainable or whether the rural recovery can really compensate for the slower growth we're seeing in urban areas. What's your view?
I'm very clear. I think the next 4 quarters, no one has a clue. What you've seen now is quite a bit of the pent-up demand of 2 to 3 months that is playing out. But to take a definite call as to what's going to happen over the next 3 quarters till March 21, it's, I think, a mug's game. No one's going to get it right. Even the company managements, particularly the mature, honest, and clear, transparent managements, have said very clearly, if you look around, we just heard from the Nestle head the other day, he himself was not too clear as to where things are headed, even though a substantial portion of the revenue would be coming from the rural market. So similarly, I don't think the rural market will be able to compensate. The jury is out on that. The reason being that uncertainty at this point of time is too high in the country, because one day you have a particular region working, the other day you have a region which suddenly has a massive outbreak and goes into a lockdown or goes into some kind of an isolation. So obviously demand is going to be impacted. So we must all accept the fact that these 3-4 quarters are a washout. So therefore we need to get companies where we can take a longer term call. So FMCG is here to stay. You need to just ensure that you get in at the right time and aren't getting it when 20 or 30% liquidity-led run-up is already, pushed up the prices. So get your levels correct. But I don't think the next 3-4 quarters, the rural demand will compensate for the, decimation we've seen across businesses.